So this small video will talk about the preference of LIFO versus FIFO and why a majority of companies tend to like using LIFO. So LIFO is used, the last estimate I saw was somewhere between 60 and 70% of inventories are valued by public companies using LIFO. And companies can use various methods for various inventory for various products within their inventory. So we don't have to exclusively use LIFO for all our inventory. We could, if we were selling farm equipment, we could price tractors using LIFO, and we could price I don't know, balers using FIFO, and it just really is a mixed bag in terms of how you apply it. But given even that ability to use different cost methods within a single company, 60 to 70% of all inventory has a LIFO cost assumption. So why is that, right? Why is there such a clear distinction and preference for LIFO? And really, it revolves around the basic, I don't want to call it an assumption because it tends to be true over long periods of time, but inventory costs rise over time. So the cost of producing or obtaining inventory tend to rise over time for manufacturers and retailers. So if we think of it in terms of a graph, here's time, and we have inventory costs on the y-axis, then we're going to see a slow but gradual uptick over time, right? That's not too gradual, but I'm trying to make a point here. So if at the top, we think about what LIFO is doing with these costs, and at the bottom, we think about what FIFO is doing with these costs. And I'll emphasize that by using a different color here that hopefully will show up to some degree, especially if it's a nice bright pink magenta. Right. So on the top, then, that means that LIFO is going to put the more recent costs, because this is time, right? If we purchased here and here and here and here, right? These are the more recent purchases. Those are going to cost of goods sold. And then LIFO would treat the rest of these guys as inventory. This is our ending inventory, because this is all coming from the idea that with everything we have available for sale, if we know that our beginning inventory plus everything we've purchased over the period is going to give me goods available for sale, well, then there's only two places for goods available for sale to go. They could either have been sold, or their value could still be at our place of business in the warehouse, and then we'd call that inventory. So this line has to be perfectly split between cost of goods sold and inventory. FIFO, of course, does the exact opposite. It assumes that I sold the oldest stuff and that my more recent purchases are going into the inventory account. And so you can see, based on this idea, if we think of this as this graph, that FIFO puts the more recent prices, which, if costs are rising over time, are going to be higher than the older prices. It puts those higher prices into inventory. FIFO does. It puts the lower cost items into cost of goods sold. Whereas LIFO does the opposite. It puts the older, lower priced inventory into the inventory account and assumes that we sold our higher priced goods and creates a higher cost of goods sold. And so if we put this out into a more tabular format, and remember, it helps us to recall that when I'm talking inventory, I'm talking about my ending inventory, which really is my inventory account balance. Cost of goods sold is the second column, even though that's kind of ran over into it. Cost of goods sold is the second column. These are the only two things that a cost flow method will affect. It just affects how much I allocate to COGS versus how much I allocate to inventory. And we're only going to look at LIFO and FIFO because these are the two extremes. Weighted average cost would come in, obviously balancing these higher priced items and these lower priced items because we just take the average of all the costs for things we purchased during the period under average costs. So we're looking at the extremes. We see here that LIFO puts into cost of goods sold the higher priced inventory. So it will be a relatively higher dollar value than FIFO, which puts these lower priced items into cost of goods sold. So relative to FIFO, LIFO reports higher cost of goods sold. The same but opposite is true for inventory. LIFO puts the lower cost items into inventory, whereas FIFO likes to ascribe those costs to the more recent purchases that are higher priced when inventory costs are rising over time. So we have this different piece that we are looking at here, where the two methods are reporting very different things in very different places. Remember, ending inventory is a balance sheet account. So FIFO will bring my asset value up because it'll report higher dollar values in my inventory, whereas LIFO will put lower priced assets in my inventory account. Cost of goods sold is an income statement account, so LIFO is going to recognize more expense in cost of goods sold than FIFO will because inventory prices tend to rise over time. So why would a company want LIFO if it's recording more cost of goods sold and reporting a lower dollar value of ending inventory on my balance sheet? It seems like we're losing on two fronts. We're reporting more expense, we're reporting less asset. So if you think about how that's going to roll through the income statement, if we're thinking of sales revenue, where we start off at, because immediately we subtract cost of goods sold, and then that gives me my gross profit for the period. Well, one thing that cost flow methods definitely don't affect is sales revenue, right? They do not affect at all the price we charge our customers for the goods we're selling. So sales revenue is not affected. Cost of goods sold is. If I adopt a LIFO, I'm going to record a higher dollar value of cost of goods sold. So if I record something with a higher dollar value and I'm subtracting it from something that is not affected by my choice of cost flow methods, then I am going to report a lower dollar value of gross profit. Now this will carry forward, right? We subtract operating expenses, we subtract non-operating items, we get pre-tax income. That pre-tax income will still be lower because we reported higher cost of goods sold. So I'm just short of showing you how the effect will continue down to this point, where if we have lower pre-tax income, we record less tax expense. Right? We do not have to pay as much tax expense. Now, it does come at the cost of the fact that not only will our pre-tax income be down, yes, we'll record less tax expense, but ultimately our net income will still be at a lesser dollar value. Okay. So why do companies prefer to save tax by reducing net income? Now, to understand this, we have to understand a couple of things. First, tax reporting to the IRS is distinct from financial reporting, which are made for shareholders, capital market participants, all the parties that use financial statements, right? All the outside parties. So US GAAP tells me how to report in my financial reporting. The tax code put out by lawmakers, by legislators, by Congress, that forms how the IRS looks at our tax returns. So a company oftentimes chooses to report differently on their tax return than they do in their financial reports. And that's totally okay, except in one case. And that one case is LIFO. There's something called the LIFO conformity rule. And LIFO conformity tells me if LIFO used for taxes it must be used for financial reporting. So there's no way around it. If I use LIFO for my taxes, because that's what I'm trying to do here, right? I'm trying to report higher cost of goods sold on my tax return so that I report less profit and less pre-tax income, and it'll trigger less tax expense. But if I do that for my taxes, I have to use it for my financial reports. And so my net income will be less. But because of these reasons, companies predominantly, not as a exclusive rule, right? It's not 100%, but 60 to 70% of all inventories are kept using LIFO. And it has that appeal. The FASB tried to get rid of LIFO, and companies lobbied heavily against its removal. It even got politicians into the fray, trying to protect their constituents' tax breaks. IFRS, International Financial Reporting Standards, notably does not allow companies to use LIFO at all, ever. All they allow is FIFO and weighted average cost. So LIFO is a bit contentious, and it's not going anywhere in the immediate future from US GAAP because it helps too many corporations with their tax returns.